Okay, so I think we're going out live now. So welcome everybody to our NECAGuard webinar. Today's topic is on trade credit, a very interesting topic always, but particularly this year with some major issues in the industry that our partner NCI will talk about. As background, WTW has worked with NCI, a specialist in trade credit insurance, for a long time. We partner with them because they are the experts in this industry, and Prudence leads a fantastic team there. That's any inquiries, her team is going to be able to sort you out, no worries. So yeah, I'll hand over to Prudence and she'll take you through.
Excellent. Thank you very much, Alex, for that introduction. As Alex mentioned, I'm the Executive Manager for New Business and Partnerships at NCI, and I'm absolutely thrilled to be able to present to you guys today. This is an interactive session, so certainly if you do have any questions, I look forward to them during the piece or even at the end. But today we're going to cover off what is trade credit insurance, what the market is actually doing currently, what NCI can do for you as a trade credit insurance client or our other services. So there's quite a few different things that we're going to cover off today, but if you've got any questions, I certainly do look forward to answering them. So let's get started. So what is trade credit insurance? At the end of the day, it's basically the protection of your debtor ledger. So if one of your debtors unfortunately doesn't pay you either for a very long time or a short period, that's actually known as protracted default, or they fall insolvent, a trade credit insurance policy can be triggered, and it will often pay between 85 to 95% of the debt. So a huge amount is then injected back into the business so that you guys can keep on working and doing what you do best. We often see bad debt as a very high cost to business. So certainly by having this type of insurance in place, it will enable you to certainly sleep better at night. The credit insurers in my market are very few in comparison to what Alex has to deal with. You'll see here that there's quite a few names that you may not have been familiar with. We've got Allianz Trade. Allianz are a massive general insurer, but they also do provide trade credit insurance lines. Recently, they have done their name change to Allianz Trade. Before that, they were Euler Hermes. Atradius and Coface are both European-centric insurers that provide trade credit insurance lines into the Australian market. QBE, you would know them as your domestic friend. They're certainly the biggest in the Australian market because they have been around the longest in providing trade credit solutions to businesses. Zurich actually provides specialist lines of trade credit to the Australian market. The Bond and Credit Co, they look after trade credit insurance in the Australian market, but they do have global reach. They also do a lot in the surety area as well. Equinox Global and Markel AIG, they are all specialist lines again into trade credit. We've got Bond Global Australia, which is our newest member and friend to NCI. They actually provide surety bonds for specific projects. So gone are the day where we're just doing surety bonds on a facility base. You can also look at them for specific projects where they can replace bank guarantees or even replace retentions if you want to swap out your retentions and have a surety bond in place instead. Then you've got our last little friend there, TCUA. TCUA is actually owned by QBE, but exclusively managed by NCI. This insurer is there to provide protection for businesses that have got turnovers under $10 million. So as you can see, NCI do cover the entire market. When we are facilitating quotations, we do seek quotations from the entire market every single year. And this is not only to make sure that you are receiving the best cover possible against your ledger, but also that you are receiving, of course, the most cost-effective quotation for your business. So why do you actually look at trade credit insurance? This is a very important question, of course, and why we're here today. The first reason is, of course, you need to preserve your profit. There is no point in you guys running around like headless chooks, making heaps of money, but unfortunately not preserving that profit. And if there is a bad debt, losing all that profit at the end of the day. So the trade credit insurance will, of course, protect you in the event of that. Therefore, it will protect your liquidity and cash flow. So as mentioned earlier, claims are paid out on event of a protracted default situation or a non-payment, but also under an insolvency. 99% of cases of claims that we look at are via an insolvency, and interesting enough, it can be paid up in about 30 days from confirmation of the debt. We're going to go through a scenario a little bit later on, which will prove that it actually can be paid a lot faster than that. It's going to give you the confidence to expand your accounts. So I meet with a lot of businesses that are going through expansions, especially at the moment, or they might be buying business or doing some mergers and acquisitions. They're not confident with the ledger that they're purchasing, or maybe not confident with larger accounts that they are looking to bring into the fold of their business. So the trade credit insurance will actually look at giving them that confidence to expand, because if you do have an insurer that is underwriting that risk of growth that you want to increase into your business, then of course you're going to feel a lot more secure at the end of the day. This will in turn strengthen your credit management procedures. So by looking at those larger accounts, we will have an insurer vet them and make sure that they are worthy of the credit that you want to grant. Smaller accounts can of course still be insured and can also be vetted via the insurer, via yourselves, or via us. And so we're going to go through that process in just a little while too. And of course, it's going to add security to any shareholders or even any banks and funders that you might have. So if you are looking at increasing your banking lines or your financing lines, trade credit insurance can be used as security rather than the old bricks and mortar that often is used. So we like to enhance your credit procedures. You're adding a security so that then you can lend out further money from those situations. So a case study that I wanted to talk about, which I'm sure you all would know about, is the collapse of ProBuild. So this was an interesting one. NCI were watching ProBuild for quite a number of weeks and months prior to the actual insolvency. The debts, however, were very current. So when I say current, they were anywhere between the 30 and 60-day period. In normal construction, the DSO or daily sales outstanding is around 45 to 55 days. So we certainly saw it as being current or normal in the market. When they did fall over, however, they did leave a huge hole within the market, and we are very happy to see that there has been those holes filled by other businesses taking up the debt. However, what we did see is that we had 57 credit limits or businesses that did have a loss to ProBuild under the banner of NCI or being brokered by NCI. The value of the limits being underwritten was at $37 million. The claims lodged just at the 28th of February was at $12 million. I'm very proud to say that NCI was the first broker to have the claims paid, and that was paid within 13 days of lodgement. So it's extremely fast. The reason we were able to do that is we do have an internal claims team, and that's all they do is process claims, follow up insolvency practitioners, and make sure that our clients are having that cash injection back into their business as quickly as possible. So let's have a look at the claims in the electrical industry. Now, we all know that the last 2 years have been very stable because we haven't had a lot of claims going on. Is that going to continue? I'm sadly going to say to all of you, definitely not. In 2019, we did have claims in the electrical industry sitting at about the $18.82 million over the 12-month period. To date, in the financial year of 2022, we're already sitting at 9.36. So we are going to be reaching, we believe, at least the 2019 levels, if not higher. I actually suspect that we are going to go higher into the next sort of 12 months because we do have a lot of overdues being lodged by our clients. When we talk about overdues, to you and I, an overdue would be something that isn't paid within 1 day of the invoice being due, of course. But in insurance world, an overdue is really anything over the 90-day period. So we're talking about pretty old debt and debt that you and I would be unhappy with if it wasn't paid. We are having a great number of those come through to NCI, and that's what we watch to consider if the market is going to have a high level of insolvency. We are also seeing court actions and collection actions starting to rise. We know that the insolvency practitioners are becoming more and more busy, with the banks also issuing out actions in a faster time frame. So I suppose over the last 12 months, we have certainly seen the business community of Australia be kind to those debtors that have been overdue, but the kindness has to wear thin at some point and payment is due, and they need to be following that up. So we are seeing those actions occur. So let's look at a claim and actually how a claim is actually processed. So depending on the insurer is how the excess or the cover would be applied first or second. But in a usual claim, a bad debt of $100,000, you would less, of course, the GST because you would be claiming that under other means. You would have an excess of $5,000, which is a normal excess applicable in the Australian market. I should also mention, though, there are small business products available that do have excesses as low as $2,500, and there are also mitigation products that are also available example, where don't have excesses because they're not an insurance product, but they will allow you with a recommendation and a monitoring effect of a debtor. So certainly through this process where we have the excess of $5,000, the subtotal that is left over is just shy over $85,000 from there. 90% cover is then applied to leave us with a claim payment of $77,318. So as you can see, that injection of cash flow of just over $77,000 is remarkable in comparison to actually losing 100. And it is interesting to also note that at a 10% profit margin, you would have to sell $1 million. I'm going to say that again, $1 million worth of goods to recoup that initial loss. So an extreme amount. And this is what lots of business don't consider, is that it's not only the debt that you're actually losing, it's what do you have to replace that debt to actually equal the debt that has been lost. So in this case, as I said, a 10% profit margin, you'd have to sell $1 million worth of goods to recoup the initial loss of 100,000. So it is quite extreme. So what does trade credit insurance cost, and what are the elements that we actually look at? First is, of course, the level of insurable turnover. The higher the insurable turnover, the more you're going to have to pay because, of course, we're insuring more. What cover is actually available and what are you requesting? Normal cover in the Australian market is sitting at 90%. However, we do have clients that actually go a lot lower than that. This is the weighting of the insurer. So do we actually have a low level of cover, therefore the risk is spread a lot better with the insurer, or a higher level of cover? This will, of course, affect the premium, as will, of course, the excesses or the retention level. So the higher the excess, the lower the premium. So again, this is something that we look at. Things that will further affect the actual premium base would be the bad debt history of the business. So we only look at the last 3 years of the bad debt history to ascertain what type of risk has been associated with that business over that period of time. Size of credit limits and exposures required. So I always use the analogy of, say, a Bunnings at 100,000 and a Bunnings at 3.6 million. Even though it is Bunnings, you're actually going to be paying a lot more, of course, for that 3.6 million as opposed to 100,000. So we do look at those sort of levels and ascertain what you actually require to see whether it's going to be cost effective. Terms of payment are really important. If the insurer is on for more than 30 days end of month, of course, that is a higher risk to the insurer, so therefore it will change the costing. Industry trade sectors. So being in electrical, you guys do have a high level of claims. Sometimes it is looked at as being negative, but often we actually look at the bad debt history and the level of credit management within your business to really sell that to the insurer. And that can change their mindset on the industry itself. So we do look at the credit management of your business, how you're opening accounts, how you're collecting those debts. What are you actually doing to collect those debts? Are you making phone calls? Are you simply sending letters? So all of that will change the outlook and therefore the costing of the premium. We do often see, though, that the annual credit sales for trade credit insurance and the rate that is applied is between the 0.05% to the 0.6. So it is a large range, but again, it's because all of those other elements come into play. As a broker, of course, just like W2W, it is in our interest to find you the best solution. So often we will go to clients with a couple of different structures to be able to ascertain what is actually going to be cost effective for them. So as mentioned earlier, NCI is a full trade credit solution business. We look after trade credit insurance, of course, as a primary for our policyholders, but as well as that, we do actually offer credit services, which is credit risk management, where we provide information, reports, monitoring. We can also provide recommendations on the credit worthiness of accounts for you. If you're looking to do a merger or acquisition, often we're employed to actually look at that merger acquisition and provide financial analysis against that as well. We do provide commercial collections as well. So that is part of an insurance policy that the insurer will actually provide a rebate towards any costs, but we also do it as a standalone product. We will look at your credit application forms and make sure that they are sound, and if not, then we can send them to a legal partner. So we really do look after an end-to-end solution when it comes to the credit department of your business. We have things like the NCI Net, which is a program or a facility that allows your trade credit insurance policy and any of your other trade credit solution products through NCI to be available on the net. We provide training and advice wherever needed. So certainly we do come out and visit you very regularly, depending on what you actually require. And we will retrain staff on how to react through a trade credit insurance policy. policy. As your broker, we're here to hold your hand through the whole journey to make sure that not only you're compliant, but you're getting, of course, those claims paid as quickly as possible. So people often ask me, what's unique to NCI? Why would we actually use NCI as a broker of trade credit insurance and therefore monitoring against bad debt? There are a few reasons, but certainly the most unique data to NCI are things like repayment plans. So it's often interesting to know that a debtor could be paying you, but may not be paying everyone down the road. So we actually notify you of repayment plans and arrangements that could be occurring to make sure that you are in the best position to make those educated decisions about your debtors. We provide underwriter information, of course. So let's tell you about what CoFast is doing, what a tradies are doing, what are the limits doing, how are they reacting? Again, invaluable information for you to make those educated decisions within your business. Industry-specific knowledge. We do run many credit bureaus, so we are able to notify you of those bureau information as it does come to play. Of course, court actions and ASIC actions or changes within the debtors is very, very important. You want to know whether one of your debtors has changed the ABN or ACN number. Make sure that you actually are invoicing the correct entity. Therefore, you have rights over that payment, of course. Information on commercial credit collection actions, of course, that's very important to be notified of anything that could be overdue. At the moment, insurer decisions are over 150,000 companies is what we're actually monitoring. So it is a lot of information, but again, it's to put you in the best position possible to make those educated decisions. So a little bit more about NCI before we get into some questions, of course. NCI was established in 1985. We have a global presence. So a lot of people just think that we're Australian based. However, we are Australia, New Zealand, Singapore, Malaysia, but we also have hot desk and a part of a global alliance called the ICBA. So anywhere where you need information, a collection being conducted, or need a policy set, we can certainly look after you. We are only a trade credit insurance broker. So this is all that we provide into the Australian market. All other general insurance is of course placed through WTW. We're a member of the Steadfast Network. We have over 3,000 clients and we have fully integrated policy systems. So that allows you ease of policy and ease of management and understanding of those policies moving forward. So here we've got a bit about our locations. As I mentioned earlier, we are all over Australia, and then we have hot desks available globally through the ICBA. So broker benefits are similar to using WTW. It's all about policy negotiation and making sure that you have a consultant to your business to be providing you with A-class information so you can make better decisions. We provide that information, the service training, the limit coverage, the claims, and of course the compliance reviews. Even if you do have a policy right at the moment and it's not up for renewal, please reach out. I'd be happy to do a policy audit to make sure that you have the right clauses in place and you have the right amount of cover available in the Australian market. Often people come to me halfway through their policies and I will conduct these audits, and then I'm happy to actually manage that policy on your behalf if you wish to, even halfway through. There's no cost involved in this particular process. There is, of course, we get paid on renewal. So if we are going to be taking up a policy halfway through, we're more than happy to be able to help you guys out and make sure that you're getting paid your claims in 13 days. I mean, that's the whole reason why you've got these types of policies. As I said, we've got access online anywhere. So this is where you can manage your policy, make sure that the policy is working for you and that you are being notified of those adverse triggers or events or changes within your debtors as soon as possible. So we are very pleased and happy to see our online access being utilised by our clients. And it is really important that you guys are aware of any changes that could be occurring. So of course, the two contacts, if it's for trade credit insurance, myself, if it's for W2W, you of course speak to Alex, but we will be sending you these slides and this presentation afterwards. But I'm going to hand it back to Alex now to see if there's any questions that have come through from the members.
Thanks for that, Prudence. Yeah, we've got a few questions come in here, so I'll just have a look at those. You did touch on this a little bit, but are you able to go over again how the premium is generally calculated? What are the main factors in that?
Absolutely. So we look at the turnover, of course, but the main risk factors within the business is what we look at. So who are you dealing with? what level of insurance do you need for that particular debtor, and what credit management procedures do you have within the company? Those three areas are really critical for us to understand what sort of negotiation power we do have with an insurer. From there, a rate is usually provided, and that is negotiated back and forth before we present our terms back to the client, of course. Other things that may affect the premium are size of excess that is applicable, and of course, the level of cover that the client wishes to have.
Because you can choose to insure some of your debts, the larger debts, rather than the whole lot, right? If there were just particular contracts that were of concern.
Yes, that's exactly right, Alex. So when I first started the game, I've been at NCI for 16 years. It was, here's a black policy and you're going to have a black policy. There's no changes that are available with that. From there, the insurance market has become a lot more savvy in their understanding of what the businesses want. We are now able to do single risk policies or single project policies. We are able to do top 10 policies. We're able to mutually exclude debtors as well, which is one that we are seeing more and more often at the moment. People don't want to be insuring your Coles and your Woolies of the world, of course, or your Bunnings, or, you know, top tier type of entities. So we actually do exclude them from quotations also. So you're quite correct, Alex. We do actually go out, we seek client integration into the conversation of what actually is important to them, where their risk is and where they feel it is within the ledger. And we look for solutions around only that.
Now, this one, I must admit, when I have had discussions on trade credit with NECA members in the past, this is one that comes up. I've heard premiums are expensive. Is this correct?
Yeah, okay. So I'm going to say no. When I first started in the game, the minimum premium was around $25,000. It's now around about $8,000 or $5,000. It is a lot cheaper. It is certainly a buyer's market, I suppose, a bit like the housing market's going to be very shortly. We are seeing more competitive rates. And one of the reasons behind that is because we have more insurers than ever before in the Australian market. So certainly there is always premiums that do come up as being high, and it really has to do with the risk factors that we have been discussing earlier. But as a broker, it is my job to be able to find a solution that is cost effective for the business. So it might be that one year we need a higher excess to be able to enable a trade credit insurance policy. So all of those types of situation and changes is what I would be doing to negotiate the best possible terms.
But then I guess when we're seeing the other side of that is the claims, and from those graphs, I was surprised. I knew more claims were happening this year. I didn't realize that 2019 as well was a pretty bad year.
Yeah, it was. And it's interesting. I mean, we know that there's a lot in the media at the moment going on about the level of insolvencies that are occurring. My executives here are extremely busy on the new business front. I'd like more bodies really to be able to facilitate the inquiries that we're getting. It's really important to be able to get back to the clients and make sure that everything is being adhered to. So we actually do see the level of inquiry going through the roof, and that only happens when people are concerned about the economy. And I think right now is, as I said, a buyer's market. So you're in the best position to be able to negotiate the most cost-effective terms to the business and protect yourselves, while we know that the level of insolvency is going to rise.
So another question here is on the application process. What generally does that look like? What kind of information is needed initially?
Great question. So we have a one-pager document that we ask people to fill out. It's called a quick quote form. It has your turnover, level of bad debt that you've incurred over the last 3 years, an age trial balance to be attached, and your top 10 accounts. That's it. Other than that, there's nothing else that a client has to supply. We would then call you, go through that information, ask a few more questions about your credit management procedures before we go to market. The process from there is the quotes usually take about 2 weeks for us to negotiate and come back to you with something that we feel is actually cost effective for you and that is putting you in the best seat possible.
So another one around the claim process. What does that usually look like?
Yeah, really good question. It is different in a lot of scenarios, depending on if it's protracted default or a non-payment issue where there isn't an insolvency. In an insolvency case, they usually get that awful letter in the mail, or they get a phone call to say that the insolvency has occurred. We ask them to put forward, of course, their credit application forms, purchase orders, anything that could have to do with the account and the overdue amount or the amount that is being claimed upon. They would fill out a claim form. Again, this is really quick and we can do it online, which is really great. And then we get a confirmation of debt from the insolvency practitioner to be able to pay out a claim. With the pro-build scenario, we were on the phone to the insolvency practitioner getting that from them. So the client really didn't have to do anything. We have great friendships with the insolvency practitioners to allow us access to that information in a really, really quick manner to get that claim conducted. In the event of a protracted default where a non-payment issue has occurred and the debtor is still solvent, it can be a little bit more tricky. But as I said, it's probably 1% of claims that we have that are a protracted default situation. In those situations, we have to assume to go to collections and legals, of which NCI will support you in, and the insurer will actually pay rebates towards. If we find that we are unable to get the money back, then we are able to put in a protracted default claim over a prolonged period, which is usually anywhere between the 90 to 160 days, depending on the insurer and the actual scenario. We do also have claims that are paid a lot earlier than that, depending on what the insurer is able to collect. So they can claim before the protracted default period is actually over. So we can actually get paid claims earlier than that in certain scenarios.
But that would also be highlighting one of the benefits of going through a provider like NCI, right? You were telling me earlier before the call about a horror story of someone who's gone direct. Still waiting on a claim payment for pro-build.
Yeah, absolutely, Alex. I actually had lunch yesterday with a client that I do consulting work with. They are brokered through somebody else, but they pay me to do a consultancy piece on their policy every single year. So I was doing a consultancy piece and they turned around to me and said, "We're still waiting on our claims for pro-build." I was floored, absolutely floored. And it was really because they were looking for further information. The broker really didn't have the strength and power, I suppose, unlike NCI. I mean, we have 65% of the domestic market that is brokered through us. So we were able to push for decisions to be made really quickly. So I'll be getting involved with that claim for that particular client as a consultant. But it was shocking to hear that they're still waiting on claim payment.
Yeah. So we've got another question here that's come through around the retentions. You mentioned that earlier in the presentation. It's obviously a fairly common thing, but can you go through again how that works with trade credit insurance?
Okay, so there's two different areas of retention cover that you can actually have. Insurers do provide retention cover within their policies. It is a specialist clause, however, so it's not a normal clause that is within the policies. Again, you would have to negotiate that at the point of actually negotiating the premiums. Not every insurer will provide it, and not every insurer will provide it in this market. So there are only certain markets that will actually provide it. That's on the trade credit insurance side. If you are looking at replacing your retentions for a single project bond, that can be done through businesses such as Bond Global. Bond Global do have a agreement with us at NCI, so we are actually able to look at that and replace your retention with a bond that will be sitting there. So a bond, if you think about it, it's basically a bucket of money that an insurer holds that you're paying a premium against. So instead of with a retention where you don't get paid it for 18 to 24 months, you would get that retention back as soon as the project had been completed, and we would swap that particular performance area with the bond instead. So we have many construction companies that love to do it because it doesn't make any difference to them. They can still call upon the bond like they would hold a retention.
Excellent. Look, I think that's all the questions that we've had come through. So I'd like to take this opportunity to thank Prudence for that presentation. Very informative. I learnt a lot. So hopefully the members out there have. As we mentioned earlier, we'll be providing more information. We'll provide this slide deck out and contact information. You can always reach out to the NECAGuard team at WTW, and we'll be able to put through any referrals through to NCI, and Prudence will arrange for someone from her team to contact you. And yeah, we'll have lots more information sheets and stuff available on this area. We think it's a really important one. So yeah, hope to hear from some of you.
Excellent. Thank you very much for your time, everyone.
Okay. Thank you, guys.